Welcome to the AI 10X Investing Show, the high-stakes arena where cutting-edge machine learning challenges the masters of Wall Street. The big question, is AI ready to take on the best, or is it just another overhyped model doomed to fail? We're here to find out. In this episode, we're peeling back the curtain on February's performance. A month that didn't just disappoint, it turned into a full-scale bloodbath. AI didn't merely underperform, it got crushed. If you're someone who's watched tech stocks yo-yo this past year, you already know volatility can feel like riding a roller coaster blindfolded. But this was different. We're talking about a minus 6.13% drop for AI-powered portfolio, while the Nasdaq slipped only minus 2.74% in the same period. That might not sound earth-shattering on paper, but trust me, it is. Because when you contrast that performance to legendary human investors, like Warren Buffett, whose holdings ticked up by plus 1.53%, it's like seeing a prized fighter get knocked out in the first round. So how did a hyper-intelligent data-crunching machine get beaten so decisively? Did it overestimate the resilience of high-growth tech stocks? Did it neglect shifting macro winds like the specter of rising interest rates or mounting inflationary pressures? Or was it just a classic case of bad luck hitting all the wrong stocks at exactly the wrong time? Well, we're about to find out. Over the next few minutes, we're going to dissect February's meltdown in excruciating detail, pinpointing exactly where AI's grand plan went off the rails. Then we'll spin it forward, unveiling AI's brand new recalibrated portfolio for March 2025. The algorithm has been busy dumping dead weight, adding fresh picks and tinkering with its overall approach. Has it learned from last month's thrashing, or is this just another high-risk gamble that could spiral into even bigger losses? Get ready for a deep dive into the strategies, stocks, and signals that shape AI's decision-making. We'll look at which losers got the axe, which survivors AI's doubling down on, and which dark horse newcomers might be poised for breakout performances, if the stars align. By the end of this episode, you'll know exactly where AI stands, and more importantly, whether it's on the verge of an epic comeback, or staring down the barrel of another disaster. Let's get started. First, we need to fully grasp the scale of what happened in February. We're not talking about a routine market dip or a mild correction. It felt like a hurricane tearing through a vulnerable coastline. Day after day, negative headlines about rising rates, uncertain earnings, and wavering consumer confidence battered the market, especially high-growth tech. Our AI-driven portfolio, consisting of 15 carefully curated stocks, found itself in the crosshairs. Let's put the numbers into perspective. AI's portfolio, minus 6.13%. Nasdaq, minus 2.74%. S&P 500, minus 1.7%. Warren Buffett's portfolio, plus 1.53%. It's not just that AI lost, it got outclassed by both indices and seasoned human investors. We're talking about a scenario where the market as a whole was indeed sputtering, but not catastrophically. The titans of finance, Buffett, Gates, Ackman, didn't simply survive, some of them thrived, even in these choppy waters. That contrast is glaring. It's like a star rookie on a sports team who shows promise but misses every critical shot during crunch time, while the veterans methodically pile up points. Digging deeper, we see a few bright spots, which proves the AI model isn't clueless. Certain picks like KLA popped up with a plus 9.8% gain, an impressive individual performance by any standard. But in a portfolio context, it was a mere spark in an overall dumpster fire. The avalanche of losses elsewhere overshadowed any small victories. Now let's talk about the emotional toll. Yes, investing should be rational, but when you see a high-tech algorithm, touted as the next big thing, underperform by such a margin, it rattles confidence. Seasoned investors might shrug and say, hey, it's just 1 month, these things happen. But to the average observer, it looks like AI just got outplayed by a man who famously invests in candy companies and railroads. The optics aren't great. So, was it a function of poor stock selection, bad timing, or simply a reflection of how AI was leaning way too hard into high volatility names right before the market took a nasty turn? Likely, it's a bit of everything. But if February taught us anything, it's that AI needs to adapt or get left in the dust. To really diagnose AI's February meltdown, we have to zoom out and examine the bigger picture. The macro story heading into February had been a swirl of contradictory signals. Inflation had shown signs of cooling, but not consistently. The Federal Reserve hinted at potential policy changes, including the possibility of more rate hikes if inflation rebounded. In a rising rate environment, high-growth stocks, especially those without robust earnings, often get hammered, because future cash flows look less attractive when interest rates climb. Then there were geopolitical rumblings, regional conflicts overseas, supply chain issues still rippling through various industries. Add to that the market's cyclical rotation from risk-on to risk-off, and you've got a recipe for volatility. Investors who had been chasing high-flying tech darlings in previous months began taking profits. The slightest disappointment in earnings or forward guidance triggered outsized sell-offs in names that had been priced for perfection. AI's big misstep seems to be that it loaded the portfolio with precisely those kinds of stocks, ones with sky-high valuations and enormous expectations baked in. When the environment is bullish, that's a brilliant strategy. You get maximum upside. But as soon as the winds shift, those very stocks become prime targets for short sellers and cautious investors looking to minimize drawdowns. Throw in a few negative earnings surprises, and you've got a meltdown. Another aspect is the self-fulfilling prophecy of momentum in markets. If a model identifies a particular sector or trend as the next big thing, it's often right, until everybody else thinks the same way and jumps in. Then, once cracks appear, the exodus is equally forceful. In February, the AI portfolio was overexposed to exactly this kind of herd mentality. One negative catalyst can cause a whole block of stocks to plummet, so yes, February was a bloodbath. But that's the nature of investing. If you're going for massive alpha, you'd better be prepared for dramatic drawdowns. The question now is, how does the AI pivot to mitigate future risk while still capitalizing on growth opportunities? Let's see how it's repositioning for March. Now we arrive at March 2025, a month that some are calling a potential turning point for tech stocks and the broader market. Will interest rate fears ease? Will consumer confidence rebound? AI doesn't pretend to be psychic, but it does digest a ton of data, and based on the model's reanalysis, it has made dramatic changes to the portfolio. Out with 11 underperformers. Essentially, AI cut the stocks deemed most vulnerable to further losses or lacking near-term catalysts. Some were hammered by missed earnings. Others displayed waning momentum or negative sentiment spikes on social media chatter and analyst downgrades. The algorithm decided they no longer warranted a place. Keeping 4 survivors. Even amidst the carnage, there are 4 picks AI still views as salvageable, either because of improved fundamentals or because it believes they were oversold in a panic. These survivors might have posted mild losses in February, but the data suggests strong rebounds in the pipeline, adding 11 new names. This is where it gets interesting. AI seems to be hedging its bets with a broader sector allocation. While still leaning tech-heavy, there's a definite injection of more defensive or stable positions. Companies with robust cash flows, consistent earnings, and less correlation to speculative mania. The strategy shift, high-growth targets. We're still seeing picks like Snowflake and HashiCorp, more on them shortly, which aim for outsized gains if the market rotates back into risk-on mode. These are the stocks that can jump 20% in a week if they post a blowout quarter or land a major partnership. Of course, the downside is equally fierce. Defensive bolsters names like Adobe, Fortinet, OpenText offer a ballast. They aren't immune to market turbulence, but their valuations and track records suggest they can handle a choppy environment better than a nascent growth upstart with no earnings. It's essentially AI's insurance policy against another wave of volatility. Unexpected wildcards Dropbox, Akamai, and possibly other mid-tier tech and software companies that might be undervalued or overlooked. AI sees catalysts like new product launches, surging user bases, or potential M&A chatter that could propel these stocks. They're not always front-page news, but sometimes that's exactly where hidden gems reside. By broadening the scope of its holdings, AI aims to avoid the laser-focused meltdown scenario we witnessed in February. It's not foolproof, but it's a start. Plus, this transformation underscores a key advantage of using AI: speed. Human fund managers might stick with failing picks out of stubbornness or ego. An algorithm simply sees data, recalculates, and executes. Of course, the big question remains: will these changes actually safeguard the portfolio if the market wobbles again? Or is AI just rearranging deck chairs on the Titanic? The only way to know is to watch how these plays unfold in real time. Ready for a closer look at 3 cornerstone picks that define AI's approach for March? Let's open the hood. First on the list is Snowflake, a name that sparks fascination and skepticism in equal measure. It's either a future tech titan or an overhyped disaster waiting to happen. AI is betting big, but should it? This cloud data warehousing firm is essentially the backbone for numerous analytics, machine learning, and enterprise data operations. Their growth rate has been enviable when the market was bullish. Now, with valuations under scrutiny, can Snowflake maintain its momentum? The bull case: massive potential in big data and AI-driven services, strategic partnerships, and a recently unveiled Silicon Valley AI hub, complete with a $200 million fund to nurture next-gen solutions. Potential expansions into government and defense contracts, which could be extremely lucrative if they materialize. The bear case valuation is sky-high, leaving little room for error. Increasing competition from names like Databricks and even traditional cloud behemoths, AWS, Azure, GCP, rolling out advanced data warehousing solutions. If Snowflake reports a strong quarter and guides upward, watch out, this stock could soar. But a single earnings miss might trigger a big sell-off among jittery investors. AI is rolling the dice here, banking on technological inevitability. Second is HashiCorp. It isn't your typical household name, yet it's crucial in the realm of DevOps and infrastructure automation, tools that keep modern cloud architectures humming. AI sees enormous promise, likely due to the synergy with large-scale enterprises that rely heavily on microservices and multi-cloud deployments. Why AI loves it. Developer mindshare. HashiCorp's open-source tools like Terraform and Vault are widely adopted in tech stacks around the globe. Potential collaboration with IBM, following a $6.4 billion merger that cleared UK regulations. If that synergy pans out, it could catapult HashiCorp into new markets and enterprise deals. The risk: smaller market cap compared to giants, making it more vulnerable to market swings. One earnings miss or a whiff of competition from bigger fish, and the stock could nosedive. It's high risk, high reward, exactly the sort of play that can help AI recoup losses if things go right. Next on the list is Adobe. In stark contrast to the high-risk swagger of Snowflake and HashiCorp, we have Adobe, the old faithful of creative and marketing software. Known for Photoshop, Illustrator, Premiere, and a suite of subscription-based services, Adobe produces consistent cash flow quarter after quarter. Why AI wants its stability. Adobe's user base is enormous and sticky. Professionals and enterprises rely on Creative Cloud like oxygen. Growth potential. The company continues to invest in emerging tech, including AI-driven content generation and analytics platforms for digital marketing. Caveats. Adobe's stock is less likely to skyrocket in the near term, which might bore thrill-seeking investors. Rival platforms like Canva have chipped away at Adobe's dominance among casual and semi-pro users, though not enough to dethrone it yet. Think of Adobe as the portfolio's safe harbor. It might not double overnight, but it also won't crater at the first sign of turbulence. It's a balancing force against the more volatile picks. Combine these three, and you get a microcosm of AI's revamped approach, a mix of potential moonshots and tried-and-true giants. The real tension? Figuring out if this balance can help AI bounce back from February's losses, or if it's merely setting the stage for another lesson in humility. AI's other picks are Fortinet, a global cybersecurity company known for its robust firewall, antivirus, and intrusion detection solutions. With comprehensive protection spanning networks, endpoints, and cloud environments, they help organizations stay secure from evolving cyber threats. ANSYS, a leading engineering simulation software company, offering solutions that enable innovators to simulate and validate product designs across a wide range of industries. From computational fluid dynamics to structural analysis, ANSYS empowers engineers to design safer, more efficient, and highly optimized products. Akamai, a global leader in content delivery and cloud security, ensuring fast and reliable online experiences. Its edge computing solutions and extensive network help organizations optimize performance and defend against evolving cyber threats. Cadence, a leading provider of electronic design automation solutions, enabling engineers to design integrated circuits and systems on chip. With tools for design, analysis, and verification, Cadence helps streamline the entire electronics development process. ClearSecure, an identity verification platform best known for expediting security checks at airports and venues. Using biometric data such as fingerprints and iris scans, it ensures quick, touchless, and secure identity confirmations. Qualcomm. A global leader in wireless technology, best known for developing advanced chipsets and modems that power smartphones and IoT devices. Through extensive research and development, Qualcomm drives the evolution of 5G and beyond, shaping the future of connectivity worldwide. OpenText. A leading provider of enterprise information management solutions, helping organizations securely manage and leverage their content at scale. Their robust software suite streamlines document management, collaboration, and data analytics, empowering informed decision-making across the enterprise. EPAM Systems. A global provider of software engineering and digital platform services, empowering businesses to transform and innovate. By combining engineering excellence with consulting expertise, EPAM delivers seamless solutions across various industries. Keysight Technologies. A leading provider of electronic design and test solutions, enabling the development and validation of cutting-edge innovations. Their advanced measurement equipment supports a broad range of industries from wireless communications to aerospace and defense, ensuring reliable performance and product quality. Dolby. A renowned pioneer in audio and visual innovation, best known for its surround sound and immersive technology. Its advanced solutions elevate the entertainment experience across films, music, and interactive media, delivering breathtaking clarity and depth. Zoom. A leading video conferencing platform, enabling seamless virtual meetings, webinars, and collaboration. Its user-friendly interface and robust features have made it a go-to solution for remote work, education, and personal connections worldwide. Dropbox. A cloud-based file hosting service that streamlines file storage, sharing, and collaboration. Its intuitive interface and cross-platform compatibility make it easy for individuals and teams to keep files organized and accessible anywhere. A brief summary of March 2025 new editions entry points. March 2025 full portfolio recap. With this recalibrated portfolio in hand, the burning question is, can AI reclaim its dignity and prove last month was a fluke, or are we in for round 2 of a slow-motion car wreck? The beauty of this format is that we'll get a pulse check mid-month. In just a couple of weeks, we'll revisit these same stocks, comb through any earnings updates, track their price movements, and see how AI stacks up against the indices and the human titans. By then, we'll have answers to pressing questions. Did any of these picks skyrocket on a blockbuster earnings report? Did one of them implode on bad guidance? Or did macro events overshadow everything? And here's the real kicker. AI might be right, or completely wrong. But you won't know unless you tune in for our mid-month update. Will this portfolio be AI's comeback story, or another disaster in the making? Time will tell. Alright folks, that's a wrap on our deep dive into February's bloodbath and the potentially game-changing portfolio shift for March. Remember, AI doesn't feel shame or regret, it recalculates. The question is, does that recalculation translate into real gains, or just new ways to lose money? If you're as curious as I am, subscribe right now and hit the notification bell, because our mid-month check-in could reveal whether this new approach is pure genius or another faceplant in the making. Drop a comment below and tell us which stock you think is the hidden gem. Maybe you see something in Adobe's pipeline that everyone else is missing, or perhaps you think Snowflake is just a bubble waiting to burst. We want to hear your take. With that said, thanks for watching, stay sharp, stay curious, and buckle up for the mid-month update. We'll see you on the next episode of the AI 10X Investing Show. Remember, this video is strictly educational and for entertainment purposes only. We're not your financial advisors. The market can be unforgiving, and no algorithm, no matter how sophisticated, can guarantee profits. Always do your own due diligence.